Hello, everybody. Good afternoon, good morning, depending on where you're calling in from. This is a national event, so we are very excited to have CFA charter holders and CFA society members from across the country joining us for this interesting and somewhat different program that we've put a lot of thought and energy into sculpting and developing, taking the familiar aspects of finance and the unfamiliar aspects of the music business, and hopefully building a bridge so that all of you can walk away from this with a thorough understanding of what drives revenue in the music industry. My name is Tom Galgano. I'm head of programming for CFA Society of Washington, D.C., along with my colleague, Jeannie Shen. We are thrilled to be your sponsors for today, but we also want to thank the CFA Society of Nashville for helping us coordinate the speakers and market the event. For today, a couple things to keep in mind before I hand it over to your esteemed moderator, Andrew Kintz. First of all attendees are muted. So if you are attempting to shout at us or yell at us or question us, it won't work. We'd ask you to put any questions you have in the chat, and Andrew, Paula, and myself will navigate through. Second of all, we do have some links in the chat and documents you might find as useful guides to today's conversation. I'm also going to highlight that David Schulhof, one of our esteemed panelists with MUSQ, included in the attachments an invitation for an event on September 4th in New York City to celebrate his product. And then finally, today's webinar will be recorded and is available for all registrants for replay. With that, I just want to say thank you very much to everyone who signed up and everyone who's on the call now. Thank you especially to our panelists and our esteemed moderator, Andrew. With that, I will hand it over to Andrew to take you through the remainder of the content. Thank you very much.
Fantastic. Thank you so much, Tom. So guys, my name is Andrew Kintz. I am a music banker. I live in Nashville, Tennessee, and I work with mostly clients who own music copyright and work with music copyright. And everybody that's a panelist either owns or works with music copyright and really has spent the majority of their careers with really music as an investment. And so we're going to be talking about that today. The topic has a lot of importance just because music has really become an asset class. And you would see that asset class, the way it behaves is really different than equities, fixed income, real estate, some other larger asset classes. We're going to hear from, each panelist is going to introduce themselves. Really excited and feel honored to be in the room with all three of them, as all are really top notch in their particular field. So, with that, I want to get into who we are, and I'd love to kind of go around the horn with first Conor and then David and then Larry. And so Conor, coming from one banker to somebody that lends money and invests in equity, tell us about yourself.
Yeah, thanks, Andrew. Hey, everyone. I'm Conor. I'm a vice president in the opportunistic credit business at Carlyle. We're a roughly 15 billion AUM pocket of capital investing across the capital structure in private businesses. I spend my time across a variety of industries, technically industry agnostic, but have spent a disproportionate amount of my time in and around the music ecosystem, from service providers and live entertainment to investing in the majors in certain instances. But most relevant to this discussion is our investment in Litmus Music. We stood up a platform in 2022 with a couple of industry veterans to really invest in music as an asset manager, and have been acquiring assets for just 3 years now.
Great. David, a pioneer in his space.
I'm just old now. It's great to meet everybody here. My name's David Schulhof. I've been in the music and media business for the last 25 years, having run a number of public and private companies in the space. Most recently, I am the founder and CEO of MUSQ, which owns the MUSQ Global Music Industry ETF. We are the first pure play music exchange traded fund that's traded on the New York Stock Exchange, giving investors total exposure to the global music industry. I was previously the president at a company called Live One, which owned Slacker Radio and Podcast One. I was the president of music at 2 film studios, and Prior to that, I was the founder and CEO of a private equity-backed music roll-up called Evergreen. We owned everything from Bill Monroe to Death Row, which we sold to KKR in 2010. And I really started off my career as a lawyer and then working at Miramax Films, overseeing motion picture music, soundtracks, and music publishing. So I've really been most of my entire career in and around music, recorded music, music publishing, and I'm extremely excited to tell you more about the public vehicle that we've launched, which is now 2 years old, called MUSQ.
Fantastic. Thank you so much, David. And then the illustrious Larry Mestel. All
Illustrious.
yours.
Thank you, Andrew. My name's Larry Mestel. I'm the founder and CEO of Primary Wave Music. I've been in the music business for 35 years, ran Island Records for a while, Arista Records, Virgin Records, started Primary Wave 20 years ago, come this March in 2006. We have 5 billion of AUM now, almost entirely iconic and legendary music. We're the largest owner in the world now of legendary music. Artists like Prince, Bob Marley, Whitney Houston, James Brown, Stevie Nicks, Bing Crosby, Guns N' Roses, Notorious B.I.G., et cetera, et cetera. We have a very unique marketing and branding and content platform and infrastructure, and really it's all designed to drive value, which we'll get into later on.
Fantastic. Thank you so much. So I want to get into, what are we actually talking about here today? We're talking about music, and a lot of times when you hear that, some people are thinking of a concert they went to 20 years ago. Some people are thinking about what they're listening to on their way home from work. I'd love, Paula, for you to pull up that first slide that just says original song on it, so I can just give a very, very short primer on what we're talking about. Are we able to pull that up? Content is loading. Okay, so I'm going to just talk about 3 slides very, very quickly. When a song is consumed, it creates royalties that have to be paid to the 2 copyright owners. Every single song is essentially 2 copyrights. Probably the best example I have is All Along the Watchtower. Fantastic song written by Bob Dylan and recorded by Bob Dylan in the 1960s, actually recorded right outside my window in a studio that I can see from here. So Bob records that song, but everybody really learns and gets to know that song probably through classic rock and Jimi Hendrix's version. There are all kinds of other versions. So let's just say you're listening to Jimi Hendrix's version of All Along the Watchtower. You are basically listening to a copyright that is the lyrics and melody were written by Bob Dylan, the songwriter, and the publisher. His publisher owns that copyright, while consuming that same song, the master recording of that song where Jimi Hendrix is singing is generally owned by the record label, and Hendrix, and now Hendrix Estate, has a right to some royalties from the consumption of that music. So this can get very complicated because there are a lot of people that get paid as a song gets consumed, and third parties need to collect these royalties and then distribute them. So we're not going to get into all of those mechanics, but essentially I want everyone to know that when you consume a song, say on Spotify or Tidal or on satellite radio, however you're consuming a song, you're consuming 2 copyrights. One is generally owned by the publishing company. One is generally owned by the record company. Sometimes they're just broad music companies that actually own both. So if we go to the next slide, I want to just show how these assets have behaved over time. And so if you look at the next one, this is essentially the publishing asset. This is the lyrics and the melody. I mean, guys, I'm sorry this doesn't go all the way back. My career is probably 17 years in this business. It looks like this going all the way back. It essentially is just kind of ginning off, increasing returns year over year. Go stay on the publishing part if you would. So, there you see some spikes, interestingly, in 21 and 22. We think that is mostly pandemic related. People left the office and they sat in their houses, and while they did, they had Alexa playing them songs. So basically the consumption of the lyrics and the melody, that copyright, has been just nice and steady over many, many years. If you look at the next slide, it'll show the way the master recording has behaved. A lot of this is associated with, what used to be the purchase of a physical asset, a record, a cassette, then and then a CD. You can see revenues absolutely crashing in this business from 15 billion down to about 7.5 billion. And then they kind of hit their nadir in 2015. And then all of a sudden, the master recording, mostly due to streaming, that dark green part of the bar graph, these things start really behaving nicely and are, have been increasing at a far greater rate as far as the revenue generation than that slow and steady publishing revenue. We as a bank love both as essentially our collateral on any of the loans that we're giving to publishers, labels, music companies, funds that own music copyright. So I want to just use that as maybe a backdrop because I want each one of our panelists to share, tell us about this asset class. How does it behave for you? What do you think about it? You've been investing in it and spending a good chunk of your career studying it. So why don't we go around the horn and talk about, how each of you would describe this asset class? Why don't we start with David, pioneer of the first index fund in music?
Yeah, no, thank you very much. So music to me is really, it's like a monopoly. It's really a toll road. It's the business of investing in the purchase of intellectual property rights, either the song's composition, which is the melody and the lyrics, and or the sound recording. And it gives you the right to exclusively license that music in film and television and advertising. Music also generates very predictable passive cash flow that is uncorrelated with the traditional financial markets. And so with 87% of all music consumption in this country dominated by streaming today and 70% worldwide, it's a very predictable asset class to own. It's protected by copyright, which is typically life of the author plus 70 years, and allows the owner passive income for many decades. Music royalties are also recession resistant. They perform well during economic downturns. We also think that music today is extremely undervalued and undermonetized compared to other media assets, which represent an extremely compelling investment opportunity in its asset class.
Let's go. Keep going. That was fantastic. Thank you so much, David. Let's take it to Larry. Tell me, because you're finding iconic music. I've been excited to hear your answer.
Yeah. So I don't want to repeat what David said, so I'll just add on it. But he also said something that is very contradictory to our ethos, which I'll get to in a second. So first of all, we are a group of very, very passionate music executives, right? We're all about protecting legacy. But why is this asset class so good for investment? I think that's really the question. So first of all, I like to say that music and what we do is the good DUI, right? DUI is bad, but music DUI is great. And what do I mean by that? First of all, D for duration, right? Think about this. When an artist creates a song, that copyright is staying out of public domain for 70 plus years after the death of the last writer on a song, right? Very, very long duration. The U in DUI is uncorrelated that David mentioned, right? But with primary wave, with our company, it's not only uncorrelated to the market, but because we don't have debt, we don't use debt to achieve our mid to high teen returns, unlike the rest of the business that likes to over leverage. We are a very, very uncorrelated asset with primary wave. And then the I is inflation, right? If you look at most assets, they're affected by inflation in some way. This asset is inflation positive, right? Why is that? Because every time Spotify or Apple or Amazon raise their rates, we as rights holders are the beneficiary. Now, what's the difference, right? Everyone in this business has DUI, duration, uncorrelated, inflation protection, not necessarily uncorrelated to interest rates if you're leveraging, but in general, right? The difference is this. When David talks about passive income, that is the opposite of what Primary Wave is all about and what we do and why people are investing in us. And that's because of the alpha effect, right? We are creating alpha. We are not a buy and hold strategy like the rest of the business. Almost everyone in this business will buy, put the songs in a drawer, and hope that someone comes along, some movie producer, some advertiser to use the music. We have 115 professionals, 75 of which are marketing, branding, and content creation. So we create a lot of alpha, and that's the difference in this business. When you are marketing and you're creating movies and you're creating and producing Broadway shows and you're doing brand deals, you're driving growth, you're driving value, you're driving returns for your investors. So we don't believe in a buy and hold strategy. We don't believe in a passive strategy. We are a buy and very aggressively market strategy. So this asset class for us and our investors has been absolutely fantastic. And when you look at other, where people put this in their books, right? Sometimes it's in real assets, sometimes it's an alternative, sometimes it's private equity. I love when people talk about credit, right? Because think about this. In credit, where do you get an uncorrelated asset, right? Where do you get an inflation positive asset? Not many places. And where can you create equity returns by marketing and delivering new content opportunities? You can't. Very unusual music class, but it's all about the manager of the asset.
Fantastic. Thank you so much, Larry. And then Conor, another finance guy.
Yeah, look, I don't have a whole lot to add that's different. What I'd say is I totally agree with David and Larry. This is a stable, uncorrelated, growing cash flow stream. And I definitely believe in the ability to actively monetize and generate alpha within the asset class, all of which makes me excited as an investor. Maybe two things I would add. One, these cash flow streams are also just inherently diverse. Andrew, you brought it up on the slide, but within each of those publishing and recorded music income streams in any given song, there's a distributed group of payers. You can quickly, stack on IP on top of each other and create a ton of diversification within a portfolio. There are nuances, of course, you need to understand to actually underwrite these assets, and that's why we created the Litmus platform to do this instead of investing out of our fund. But this stable, uncorrelated cash flow stream with a ton of embedded diversification are just factors that make it exciting plays on both the equity and credit side. And maybe more from a personal perspective, look, I think within my business, we look at a ton of different types of businesses, aerospace parts distributors, data centers, right? And I think you can make cash flow arguments for all of these things, but people listen to music. Everyone has a favorite song, and I think it's just a fun asset class to invest in.
Yeah, that's well said. I think a lot of us are in this business because we happen to absolutely love consuming the asset we're talking about. I want to add one more thing because I think it is helpful to explain. When my team, we founded this group inside this 160-year-old bank. So First Horizon, super old bank, biggest bank in Tennessee. We found this music industry group, and I have to try to explain to everyone, how does this asset behave? And you're explaining it to, 30-year bankers that have basically been doing commercial real estate lending a whole lot. And that was actually a great thing to compare it to, because I'm looking at all these buildings out here and, that have these leases, 7-year, 10-year leases. And as I tried to explain it to our own risk folks inside First Horizon, it's like this asset is kind of like a Class A building that is recession proof. And I can show you 01, 09, COVID. I can show you exactly how it behaved, and nobody stopped paying their leases. And if you ever had to foreclose upon it, which I've never done in 17 years, but if you ever had to foreclose upon it, you can actually break it up into all its constituent parts. You can sell one half of one song and you get that exact amount of cash flow. So when you think about this for a second, it would be like if you foreclosed on a building and without discounting it, you could sell one half of one room and you would get exactly what the cash flows for that one half of one room were. I mean, so to me, once people understood how superior it was to actually having, say, a big commercial building with leases all inside of 10 years, it was this aha moment of how powerful, how strong, what a great asset this would be to
Andrew,
basically diversify the base.
You're forgetting the best part, which is
Go ahead.
When a building gets old, you got to replace the roof, or you got to replace the elevator.
Amen.
Right? You don't do that with music assets.
Amen. Yeah, I mean, it basically back to your duration comment. So, thanks for you guys humoring me and letting me add that little part at the end. I kind of want to talk about how we got to where we are in the music industry. It's gone through a whole lot, over especially the past 20 years. You could see it on that record label slide, especially the way consumption of music has changed, which essentially generates revenues. I wanted each one of you guys to tell your story of kind of how did you begin to invest equity and or debt into music assets. I'd love to start with Larry. I met Larry in 2009 and learned the primary wave story back then. It was just blown away because he was so progressive and in front of really all his peers in music publishing. So Larry, let's start with you on, how did this whole thing get built? How'd you build Primary Wave?
Literally one brick at a time, right? We started with zero and we've grown very substantially over the years. As I said, we started 20 years ago, back in 2006. We have about $5 billion, a little over $5 billion in assets right now, almost entirely iconic. Interestingly, we never should have been let in the business by the majors, right? Because all we've done is taken all that market share away from mostly majors, right? And many of the other companies that are trying to do what we're doing in the space as well has redistributed market share. And frankly, I think the reason is that a lot of the major music companies had trouble understanding the fact that artists wanted more than just a check. So our entire thesis is partnering with the artists. So, as an example with Whitney Houston, when we bought into the estate, we didn't buy 100%. We bought into a partnership interest. So we bought 50%. We own 50% of Prince, 60% or so of Stevie Nicks, 70% of Frankie Valli in the Four Seasons. So we're always partnering with the artist to keep the artist engaged. And it's always easier to market. It's always easier to create when the artist is supporting you and involved. And frankly, we have consistently done two things very different than the rest of the business. And I never mind sharing it. The secret sauce is not so secret because, it's easy to talk about, hard to implement. So the first thing you need to do to be successful in this business is you have to curate appropriately. And I tell this often to investors, sounds easy, right? You pick the artists that you want to be in business with. But, most of our competitors a lot of people have raised a lot of money in this space over the last 5, 6, 7 years. We've been doing this a long time. In curation, it's more about what you don't buy and what you shouldn't buy than what you should buy, right? What shouldn't you buy that many of our competitors love to buy? Why? Because they've raised money, they have to spend it, it's burning a hole in their pocket. We don't have that urgency the way we're structured. We have so much deal flow because of the brand we built and the platform we built. We can afford to be very choosy about what we're buying. So the first thing you don't buy is you don't buy new music. You don't buy Drake. You don't buy Dua Lipa. You don't buy Taylor Swift. You don't buy Ariana Grande, Justin Bieber, The Weeknd, etc. Because if you do, you are very likely to lose principal. Why is that? How are you going to generate a mid to high teen return or even a low double-digit return when the earning streams are falling on the assets and you don't have the ability to market? right? So if you're buying Drake or you're buying The Weeknd, you're buying their hits at the top of the market. 2 years later, 6 years later, 8 years later, those earnings are falling. So good luck to our competitors that buy new music. The second thing you don't do, and this is very controversial, okay? We don't buy new country music. Andrew, I know people in Nashville are going to be very upset about that, but if you buy, I'm not going to name names, but newer country artists, you are going to lose principal, not just generate bad returns. Why is that? Because when you're sitting at home and you're watching TV, how often do you hear a country song on a network show, on a stream show, in advertisements, right? In feature films? Well, you don't. Our investors expect we're going to deliver a mid to high teen return. How do you do that? How do you double or triple the income streams in a catalog if you can't market it? You have to rely on streaming. You have to rely on technology. Well, we don't want to have to rely on luck. We want to do it through hard work. And that's why we don't buy new music. We don't buy country music. 225 catalogs, almost no country, almost no new music. For that reason, we are in the returns generating business. The second thing you have to do is you have to market the heck out of the music. Most of our competitors don't have a platform to do that. It's not enough having accountants and lawyers and finance people analyzing deals. You've got to have a team that's going to go out and work the music. So, we've got about 70 of our 115 people geared towards digital strategy. We have 17 people do nothing but digital strategy. We have an entire playlist team, an entire brand team. We create content for TikTok. We have an entire TikTok team. 9 people that do brand marketing. We create content. So I'll be fast. We created an Airbnb campaign. We got Airbnb to put up all the money to build a Purple Rain replica from the movie Purple Rain in Minneapolis so their best customers can use it. And by the way, we charge them a significantly multi-million-dollar fee to do it, right? Created a MAC cosmetic line for Whitney, a scent beauty line in 3,500 Walmart stores. We created a slot machine that's generating more money in royalties for the estate than the entire estate was generating 4 years ago when we bought into it. That's what a marketing and branding platform can do to generate income. And then on content creation, we produce our own Broadway shows, our own movies. We produced the Whitney Houston movie, biofilm. We're producing a Boy George movie. The Bob Marley movie came out a little over a year ago. We just launched at Mandalay Bay in conjunction with MGM and Five Currents, who've done the last 15 Olympic Games. We just launched our Bob Marley immersive show. We are producing it. We're not relying on third parties to come up with ideas maybe 10 or 20 years down the road. We're doing it now. When we buy, we create, and that's why artists partner with us.
That's fantastic. Thank you, Larry. Conor, so coming in through the door of private equity and getting into the music industry, tell us how you got here.
Yeah, I probably have the least interesting backstory, given I'm not in the music side of the business, but from the highest level within our fund, I'd say there are areas where we are focused on investing behind thematically, one of which is, broadly speaking, content and IP ownership in sports, media, and entertainment. We've invested.
Are you talking debt and equity? Because your credit opportunities fund. Okay.
Yep, exactly. So within this theme, we own a business that acquires film and TV rights. We own a women's soccer team, and I'd say both of those we think about as IP ownership or exposure to the ownership. We're also, as you mentioned, right, an opportunistic credit fund. We've provided loans backed by iconic film and TV libraries or owners of content in other forms as well. Within music specifically, I'd say music, IP, and rights is a category that we spend a lot of time trying to figure out the right way to invest behind. I won't get into too much of the specifics, but there are a lot of other platforms out there. I'd say they already have capital partners. We didn't feel like it was appropriate for us to invest directly into the IP out of our fund. So Conor Keevey, buying Taylor Swift's catalog probably isn't the best idea. And we didn't, our LPs aren't expecting us to invest as a passive investor in another fund either. So, ultimately we met Hank and Dan, who we partnered with for Litmus, and felt aligned on how we would create a platform with an artist-centric approach, conservative underwriting, but really managing towards active management and alpha generation. And I think the natural question is, why is a credit fund investing in music royalty asset management business and owning the equity? And this is something that we debated a lot, even in our investment committee meetings. And I'd say at the end of the day, the view that we kept coming back to is that ultimately, and we touched on this theme a lot just a minute ago, but the stability and predictable nature of the cash flow streams is almost fixed income like, right? You can almost think about music IP as a bond with a growing coupon if you're managing it appropriately and buying it appropriately. And we feel confident that you can achieve mid to high teen returns with owning complete upside convexity through proper asset management.
Thank you. And now, David, I mean, I might, David, say I'd love to hear how you got here, but if you could work into that answer, love to hear a little bit about the performance of the fund, a little bit about methodology for how you chose what actual positions are inside the ETF, that kind of thing. But yeah, please tell us how you got here with the fund.
Yeah. So a couple of years ago, I was going to do another private equity roll-up like Evergreen, which I sold to KKR. And I recognized that there were a lot of private equity-backed platforms, and they were all chasing a lot of the same assets. And I wanted to really design something very different that nobody else was doing. Number one. Number two, I recognized that there was no retail product for investors. If you were you could be an LP at Blackstone or KKR or Apollo or Primary Wave or Carlyle and get exposure to music, but there was no retail product for you to buy shares to get in and out of a fund that had exposure. So that was sort of the genesis of it. And so I built up the index, I back tested it. I recognized that there were a lot of exciting music companies around the world across streaming and content and live music events and ticketing and equipment and technology. And so I wanted to design an index to give investors exposure to all of that. So I back tested the product and then listed it on the New York Stock Exchange in July of 2023. With regard to performance, the fund is doing exceptionally well. It's up 25, 26% for the year, maybe 27% for the last 12 months. Some of our top holdings are Spotify, Live Nation, Tencent Music, Yamaha, and a lot of international companies. Around half the fund are international equities that a lot of investors really aren't familiar with, companies in Taiwan and China. The way the fund works is about 80% of the holdings in the ETF are all what I call pure play music companies. Those are companies that derive more than 50% of their revenues from music. 20% are diversified companies or non-pure play, and they generate more than 20% of their revenues from music. No company can be smaller than $100 million in market cap. I have something here which can you guys see that right there?
Not yet, but it might be loaded.
I don't know. I loaded it up, so okay. Oops. Do you see? It didn't work. Okay. Anyway, so we have. So there's about 35 holdings in the fund, and no company can be smaller than $100 million in market cap. No company can be greater than 12, have a 12% holding in the fund. So companies like Spotify, Live Nation are up at around 10 or 12%. And the fund gets rebalanced quarterly on the third Thursday of every month. New companies can come into the fund, and if companies get too small, they also get kicked out of the fund. So every quarter, there's anywhere from 2 to 4 companies that get added and 2 to 4 companies that go off. And for the most part, the companies are the same. The weights change every quarter. But it's a great way to get exposure to the music industry. what I also noticed with a lot of private equity firms, when they're paying 20 times for Springsteen or 25 times
Hmm.
for Neil Young, that's a 5% unlevered yield before marketing. And so we wanted to design something that was more attractive than paying 20x or 30x for catalogs. And so, from our perspective, giving investors exposure to the index is a great diversified way to not only get exposure to copyrights, which is what we've talked about today, but also to live music events and ticketing and equipment and technology, as well as streaming. And of course, we're also investing in all the record companies and all the music publishing companies. So at the end of the day, we're a product for Robinhood investors, for E-Trade investors, for family offices that are looking to invest and get exposure to the music industry with total liquidity.
Thanks. I wanted to now kind of shift to go to, the current state of the industry. I thought I might share something that's been, I guess the question is, what is the current state of the industry through your lens of your company? How are you managing these assets? I'll just have a confession. It's been pretty hard to be a senior lender in this space. There are really only about 6 or 7 large banks like us in the country that have dedicated divisions to the music industry, where all the bankers, all the portfolio managers, everyone's just managing the music portfolio. We've originated a couple $2 billion of credit outstanding, and one of the things I'm experiencing is payoffs of my earning assets. They are shrinking, and the reason they've been shrinking a little bit has been related to asset-backed securitizations. So now, what used to just be the bank syndicate with the 6 or 7 banks that know this business and are deep in it, coming together to lend money to a fund or a publishing company secured by these assets. Now all of a sudden, others want to securitize that debt and sell that debt, which is essentially paying off the bank group. So that is something we're experiencing. It's funny. I do believe a rising tide lifts all boats. I think that we'll recover just fine from our payoffs, and we'll replace them with other great earning assets, because there are a lot of places where you can put debt capital to work inside this industry. But I will say that's a phenomenon. The good thing about it, and the reason I cheer it on, is it basically means that there are deeper pools of capital for those that are best at managing these assets. I'll say it one more time. There are deeper pools of capital for those that are best at managing these assets. That is a really good thing, I believe, for the 3 panelists. It's a really good thing for myself, as well as my peer banks who are in these deals together with me. And so, but I want to now just kind of turn it over and talk through that same thing as far as the that current state of the industry. Why don't we were just, I might shift this up a little bit. Larry, could we hear from you on as far as, what's happening right now with Primary Wave, current state through your lens at Primary Wave?
Well, we've basically just in the process of wrapping up our latest fundraise. So we have probably $1.5 billion in the pipeline of acquisitions. We've already invested well over $500 million in assets this year. And again, it's sticking to our strategy of icons and legends that are under commercialized, by the way. We don't buy artists or music that has been over commercialized, because again, we've got to generate a return. As far as the industry in general, streaming in the Western world, in the UK, Canada, US, Europe, is starting to plateau.
Yeah, it's kind of yeah.
It's not flat. It's still going up at a very nice pace, but it's not the double-digit year-over-year increases that we've seen. So we still believe that there's significant opportunity for us because of what we invest in the UK, in Canada, in the US, Australia. But we are also focusing on emerging markets where I think there's going to be significant growth over the next 5, 6, and 7 years. So we
You're saying Latin America, Southeast Asia, where are we talking about?
Good question, Andrew. So we bought a company a few years ago in India. We partnered with the Times company. We bought an interest, a partnership interest, 50% interest in Times Music. So we believe very, very, very much in significantly in India. We bought a company in Brazil, Nas Nuvens. So they're one of the 3 or 4 largest music companies in Brazil. They are basically a mini primary wave inside of Brazil. So we believe in Latin America. We believe in the Indo-Pacific region. We just finished a deal in Vietnam and in Indonesia. We're looking at a company in Malaysia. So listen, the markets we're looking in are mainly South America and in Asia. I think Africa is going to be a force, but I don't think it's going to be a force for a long time. So we're not really investing in Africa right now, and it's not interesting to invest in places where you can only generate a single-digit return.
That's great. Conor, what you seeing?
Yeah, I'll break it out into 2 parts. One on the Litmus side, one on just Carlyle as an investor, right? I think on Litmus, we're at a different point in our company's evolution than I'd say Larry at Primary Wave is, but we're still in the early innings. We've spent the last 3 years building out the platform, establishing process, acquiring an initial portfolio of iconic catalogs, and I'd say we'll continue to build a portfolio and also just refine our active management approach. This industry is not one where there's a TAM issue, right? You have the long back catalog from the last 100 years, for lack of better words, new music coming out, geographies, as Larry mentioned, that are growing at higher clips than maybe developed markets. So there's a ton of TAM to address. And as we've kind of built up our initial portfolio, it's lending way to much better active management, I'd say. Maybe from the Carlyle angle, um, there's a ton of new opportunities coming across the desk every day. New platforms that need capital. There are legacy service providers. This is kind of a new theme that I'll say that maybe have a catalog of some sort that are now trying to double down on that. And then, I think the elephant in the room for music, right, is AI. And we're starting to see that initial clip of opportunities come through on AI-driven service providers that I think benefit all of the people on this call, right? And can kind of further catalyze value creation. So, from the Litmus side, very excited. From the investment general side in Carlyle, expecting to see a continued strong deal flow.
Yeah. And David, wrap it up with this question of kind of current state of industry through your eyes / the fund.
Yeah. So we think music today is extremely undervalued and undermonetized. Music's cheap compared to what you pay for other services like Hulu, HBO Go, now, Disney Plus and Fox One. At $11.99, that's like half of what you pay for Netflix, almost half of what you pay for HBO Go. That's why you see all the streaming companies raising rates almost every quarter, because when they raise it by 10%, there's very little attrition, and it drops substantial revenue to the bottom line for all those companies. So Spotify, stock's up almost 100% for the last 6 months, almost 150%. Companies like Spotify and all the other services are going to continue raising rates to make them on par with other media services. And then, all the streaming companies pay 70% of their revenues, which are called the total content costs, to all the labels and the publishers. So that's why when there's growth in streaming, it's hitched to the content owners. So we think that the market is expected to double in the next 7 years from 100 billion to 200 billion. If there are folks on the call who want to really digest more about the industry, I would refer them to the Music in the Air report. Lisa Yang is the top worldwide analyst from Goldman Sachs that can talk about the future growth of the industry. But we think we're in the very early stages of where music is. It's expected to double. Paid streaming subscribers are expected to double between now and 2035. We're at 800 million paid streaming subscribers today. That number is expected to go to 1.6 billion. So with our fund, with our ETF, we're really capturing all the growth and all the innovation around music, and investors are participating with that growth. So we think that, again, firms like JP Morgan have called music the best content story in the history of the media business. And what's interesting, if you look back, music, people thought music was for free for a long time because, they were listening to radio and they didn't think they needed to pay for it. Folks are actually accustomed to paying a lot more for music today than they were 25 years ago when there were CDs. They paid $300-400 a year. Now they're paying $120 a year to get access to 250 million songs. So the customer's psyche is used to actually paying more. That's why they're paying up for tickets to Beyonce shows and Taylor Swift shows. And so we think that the average consumer is going to be spending a lot more music in the coming years, and we want to align ourselves with that.
Mm-hmm. Well said. And that was a bit of a good shift kind of into what we're seeing in the future. Because we have Carlisle on the phone, I want to talk about something that is kind of a Nashville specific thing down here. This is a kind of a songwriter town. There are lots of people up and down Music Row right here that are literally writing songs right now and turning them into their publisher to then be exploited. And so when private equity started getting into the space in a big way, call it 7 years, there were some people that said, this is a bad thing for the industry. We got Blackstone buying this and KKR and Apollo and I don't know if they said Carlisle. I don't think they did, but they said other ones. And so the point is I think that it's a wonderful thing, not just because the deeper pools of capital, something we have not talked about, and that I think is also going to be kind of a tailwind for our industry, is the fact that we have extremely, extremely powerful firms now that have equity ownership in music. And those firms have large lobbying groups on Capitol Hill. They are going to fight for the rights of music copyright holders. Before it was lots of independent music publishers, maybe a few of the majors, a few record labels, trying to protect that music copyright. Now I see going forward with as much power that we have out there that owns music, that will only be a tailwind. And as a banker in the business, it makes me more confident in my loans getting repaid, and it makes me more confident in this being getting less risky, this business getting less risky. So, I'm talking about private equity, so I might just kick it to Conor, because honestly, to me, you're sort of part of this solution where now NMPA and RIAA and NSAI and AIMP and all these groups that are really fighting for the rights now have these huge, huge firms that are fighting for the same thing.
Totally agree. And look, what I'd say is, the Carlyles, every other firm that you said, right? The good thing about us is we are long only, right? We're not shorting any of these types of assets, and we're aligned with other IP owners and creators. So, we fully intend to try to create value across the ecosystem. And I think that access to capital is part of the maturation of this asset class, right? I think that, over time, private equity is, one of those forms of capital, but I don't think it'll stop here, right? The types of investors in the ecosystem will expand. We're seeing that in the ABS market, right? Which you talked about earlier. That's driving down cost of debt for this asset class. And I think that we'll see it on the equity side as well as the industry matures and more types of investors become comfortable in underwriting these cash flow streams. And I think that as more investors see this asset class as investable, you should expect new structures as well. I think we have 3 types of structures here on this call right now, but more access to capital, more structures will just benefit everyone in the ecosystem. assuming that we're doing it, thoughtfully and appropriately pricing risk, which is, the caveat for every industry.
Oh, don't hear you, Andrew. You're muted.
Sorry. Do you see something coming, Larry, on the horizon? Didn't want to leave you out on the future.
Yeah.
What's coming?
Yeah, this is, by the way, I'm going to say this is why some people don't want me on their panels. So look, so I do see something coming. I think that, there are very positive features about private equity in music, and there are some that aren't very positive about private equity being in business, in the music business. So first of all, the fact that there's more capital is good for artists, potentially good for investors. But on the other hand, the fact that most private equity, and I'm not going to name names, no one on this panel, but the fact that they don't have any way or ability to affect value, to add value to an artist, where they're writing a check, means ultimately, the artist isn't going to gain in terms of legacy protection, creating more value, enhancing what they have, making their songs more famous again. When you're in the hands of a music company, that's simply different. Many people in the business now, many of our competitors, are overpaying. In fact, a lot of people are overpaying. Why is that? It's because people feel like they have to gain traction in the business. So when we're going head to head, and we rarely ever go to auction, we're usually only buying one-on-one. But when you go and you see that there are companies out there willing to pay 25 times, 30 times for an artist, and there was a spectacular failure, by the way, in the business a couple of years ago, right? Backed by a private equity firm who had a strategy of overpaying. When you overpay dramatically, I'm not talking about once in a while, but when you have a business plan to pay 25, 27, 30 times for an artist, think about it. That's a 3% cash on cash return before management fees, right? And then you throw in over leveraging the asset, 50%, 60% LTV. You get to the point where you can't pay appropriate dividends. That is just what's going on in the business. We don't do that. We don't overpay. We don't have any leverage, and we pay significant dividends year in, year out, and they grow every year because we grow the cash flow. So what does that mean? What it means is people like Conor and David and I are going to have the ability to buy out these private equity firms that are overpaying, over leveraging, and have no idea how to manage these assets. And those are many, by the way. So I'm seeing 3 years, 4 years, 6 years down the road, there is going to be a lot of opportunity for companies like ours to buy at lower prices, significant assets. Now, we don't buy portfolios. Okay. If you look at, KKR sold a portfolio to another private equity backed company. Well, the reason you curate is to generate returns. When you're buying portfolio of assets, it makes it very, very different, very, very difficult. So we're going to be very choosy about what we buy, but there is going to undoubtedly be significant opportunity because people that have money are looking to spend money, and they're not necessarily doing it in the music business in the right way.
I will say that even when things have blown up, and the blow up that you were referencing, Larry, that as the bank group, again, that same 7 lenders, we were tickled pink because the asset didn't get distressed and did not get fire sold.
That's right.
It was
the
sold.
bank is not going to lose money. The lender is not going to. Andrew,
That's right.
you are in a perfect position. you're not going to lose money. It's the unfortunate investors that are backing the wrong managers. One, if you're an investor, you've got to be very careful about who you're investing in, what their investment strategy is, and do they have the ability to create the types of returns you need to see? And that's the issue with a lot of these private equity backed firms. People are rushing to get into the business, so not thinking about the appropriate way to allocate money or the appropriate way to add value to generate returns.
Yeah, client selection, asset selection, and then the ability to that alpha adding ability,
Correct.
which, you know, a passive investor by definition is not doing. It's 3:59 in Nashville, 4:59 on the East Coast, which I think is a time to shift to some questions. Paul, I don't know if you're able to read any that are in the chat. If you'd like to, please do, and they can be specific. I've got I have some other questions that we can hit that I know these folks would answer really well if we get into those. So, do you see any, Tom or Paul?
Hey, Andrew. Yeah. And really great content, guys. Please keep it coming. So there's one question in here that I'll read to you from Adana. It says, are panelists concerned about AI infringing on the royalties / copyrights through mimicry or users skirting legit services like Spotify?
Great question. We were just talking about this in the 10 minutes before, as I was asking about Velvet Sundown, which is an all AI band, which you know, don't listen to them on Spotify because nobody's getting paid. Does anyone want to address AI? It's one of the main things that we talked about in New York at the Music Investor Conference in June. Yeah, we're needing to adjust. Anyone want to take that one?
Yeah, I'm happy to jump in there.
Thanks, Dave.
Okay, so first, AI and piracy, very small impact on the music industry today. Bark is a lot more than its bite. Okay, I refer folks to reading the Goldman Sachs report, right? There's a lot of fear. It is obviously an issue, and it's an issue because in this country today, there's no federal copyright protection in your voice, right? So that's why you saw fake Weekends and fake Drakes being uploaded to Spotify, and immediately there were takedown notices that were sent by Universal to bring them down. But it's something that needs to be done. You have bills before Congress today. You have like the No Fakes Act, which is the Nurture Original, Foster Art, Keep Entertainment Safe Act. You have the Generative AI Act. The issue comes down to this, in my opinion. Should we allow companies like Suno and Udio or OpenAI and ChatGPT, should they be allowed to train their algorithms to sound like popular artists? To me, they shouldn't, right? To me, that's piracy, but something needs to get done at the federal level. At the state level, you have things getting done. In Nashville or in Tennessee, for instance, you have the Elvis Act that was passed that makes it a crime to lift an artist's voice and misappropriate that. And we're going to see other states act like that. There are a lot of benefits to AI, right? Artists can create new music. They can create samples. Songwriters can use AI to write lyrics. But we certainly can't allow for the infringement of artists' voices. We can't pretend that there are, you know, copyrights that sound like popular artists. And to me, those are the big issues. But something needs to happen at the federal level.
I'm going to add something where, you know, just a real-time thing that's happened is over the past 2 years, we as a bank in our client selection / collateral selection exclude production music from any valuations. And so we're only talking about sort of iconic, evergreen, 10-plus-year-old music that we're able to see its cash flows over at least the past 10 years. That's the kind of stuff that we want, that, you know, that people have deep fan bases. But if somebody's just creating production music, say for film and television, and it's the walking down the street music, AI can do that very easily. And whoever originally created that walking down the street music for that film, we see that value, it does have significant risk of of declining dramatically because of AI.
Completely agree with you, Andrew.
Yeah.
And would I just maybe add one thing too, when some of those AI songs were coming out, we looked at the kind of organic streaming volume data for the actual songs, and they
So low.
actually increased, right? So empirically, there was no negative impact just because it was kind of solved, and then, the streaming of the core songs saw a temporary uplift.
That's fascinating. I think we hit that one well. Tom, what else we got?
Okay, you can't talk about the music industry without talking about Nashville's very own Taylor Swift in this winter of the music economy.
Congratulations to her on her engagement, which I understand happened a while ago, but is now very public. Taylor Swift. What's the question on Taylor?
So with regards to the re-recording of her songs, the Taylor versions, question that Bill Scott from CFA Washington has is how did that affect the original recording rights owners, as well as some of those versions of song that may not be selling as well today? And is this a trend that you might start to see from other artists who recreate new masters of old songs that cannibalize revenue?
Yeah, I'm happy to take that. So first of all, we absolutely will never buy master recordings and have never in 20 years without getting a re-record restriction. Okay. So the guys that bought it without a re-record restriction actually got lucky because she became the biggest star in the world by a number of factors. So the fact that she wrote the songs means she controls the publishing, which means that to the extent that she didn't buy back her catalog, and she did, they never would have been able to license her songs for film, TV, advertising, anything other than generating money off of streaming. And so the result of whether they made money or not or generated a return isn't as relevant as the point itself, which is you can't buy master catalogs, and we have bought a number of them, without either owning the publishing so you control the copyright on the song, right? Or B, getting a re-record restriction for your artist. So when we buy, again, our artists can't re-record those songs, and if they do, we own them, right? In the case of Taylor Swift, when they did that original deal, they didn't get a re-record restriction because they had no relationship with Taylor. And so she started re-recording her songs to gain control over things like marketing and licensing. So you can't do that.
Great answer. Yeah, I mean, she's an anomaly just in the fact that at least my knowledge is that the original owners of those original recordings they started as Big Machine assets, they did just fine. Like nobody got wiped out or something just because she re-recorded. Because you got to think about it. If I turned around and said, "Hey Alexa, play Mine by Taylor Swift," it's gonna play the first original version unless I very much specify it. And so most people, it doesn't really. I mean, the Uber fans are like only Taylor's version, but honestly, that music's getting played so much and it increased in its play so much during the Eras tour that nobody lost.
So if we're ready to move on from Tay-Tay, we got a question from Yvonne Nielsen, a true financials question here. So he's a CFA guy, about multiples and valuations in the music industry. And Larry, you threw around some valuations. Some others shared some numbers that I think are pretty lofty for us, trading the public markets. Yep. So Yvonne's curious as to what's driving the different levels of multiples between different music assets. Also, what are some of the typical ranges you're seeing for portions of catalogs, entire artist catalogs, or larger portfolios?
Yeah. So what's driving it is very simple. There is so much money coming into the space that is driving. It's supply and demand, right? Little supply, a lot of demand. And again, that's why we almost never participate in auctions. And And the reason why we're able to do that is because of the platform we built, the brand we built, and artists are attracted to other artists of similar stature. So when you have icons, artists want to be there if they can inure value from marketing support. We are typically trying to buy in the kind of mid-teen, low-teen area. You know, that's that's a space we're comfortable in. We see a lot of activity in that area, but we are certainly at times willing to go higher to the extent that we think we can drive value. And if you look at a Whitney Houston, for example, when we bought, the estate was generating $1.5 million a year. Today, that estate is generating $8 million a year. When we, I mean, that's just a typical of how we're looking at the world when we're buying. You can afford to pay slightly higher multiples if you have the ability to generate earnings growth off of those music assets and off of those songs.
Yeah, I might take that just from a financial standpoint. The structures that we have in our senior debt facilities that are secured by these assets will often control that purchase. So the weighted average is generally in the mid-teens. For example, I'm thinking about a deal we have to a small publisher. It's an active operating entity. They're signing songwriters. They're getting music turned in all the time, which is essentially they're going to try to exploit and turn into a hit. But they also have a back catalog, which is essentially our collateral. And on that deal, we're at a 7.5 times debt to NPS limit. So basically, if they're going to borrow from us, the most they can really borrow, and they also have a 50% loan to value covenant. So we got 2 covenants in that transaction, which essentially limit them at 15 times. And if they're going to go over 15 times, they're going to use their own money because we've got to stay at 50% loan to value, and we got to stay at a 7.5 times debt to NPS. Again, in the music industry, music bankers don't use debt to EBITDA like they do in regular industries. We use debt to NTS/NLS for net publisher share, net label share, which is essentially what a passive owner would be able to receive from that. Now, Larry's an active owner, so he's able to kind of get that alpha over time. But we're looking at it as a bank perspective, meaning if we had to own this asset, we're bankers, we're not primary wave. And so if we had to own this asset, what would we be expected to collect as a passive owner? And that's why we have those 2 covenants in our deal structure.
And I might layer on just a couple of factors, right? First, multiples are inherently hard to kind of look at on a normalized basis in this ecosystem, right? I think that, vintage is one big factor, right? A young catalog, you would expect to carry a lower multiple. 2, income composition, right? We talked about the diverse income stream within music, right? But there are higher and lower quality income streams within any catalog, right? If you see something that isn't, I won't say like specifics, right? But a disproportionate amount of income from a lower growth income stream, that might also weigh down valuation multiples, right? And I'd say the last category are just idiosyncratic items that may be happening within any given catalog, right? You may have a headline multiple that looks higher, right? But there could be a reversion happening, right? There may be a portion of income coming back to the catalog next year. So the actual multiple may be a little bit lower, right? So it's very important to kind of parse apart the actual catalog while you look at the multiple.
Great answer.
Andrew, do you want to go to one of your questions while we wait for more to come in from the audience?
Yeah, happy to. Got some here. I was going to talk. I mean, I just started a little bit on deal structure. But I feel like we hadn't heard from David in a bit. So, David, I'm going to come over to you right now. I got a few questions for you. So, as far as your differentiation from other ETFs, as well as your ability to kind of get the word out to, either asset managers or people that are investment advisors, to talk about that process a little bit, how that's been going since you're a relatively new fund.
Yeah. So, okay. So last week was a big week. We onboarded Jenny Montgomery Scott. which has 150 billion of AUM and 1,200 advisors. We're in the process of onboarding LPL, Raymond James, Stifel. And then once we get up to 50 million of AUM, we'll onboard Merrill and Morgan. And then at 100 million, we'll onboard JP Morgan. So there's a process. We have a track record of 2 years, which is good. And we've got very strong performance. Now we just need more AUM into the fund. And so, so folks can buy the ETF today through their Schwab account, through their Robinhood account. And it just can't get solicited by some of the advisors at some of the bigger firms yet until our ETF is bigger. So right now we're just marketing this fund a lot through retail channels. I mean, I've been on TV a lot. Folks can, there's a lot of interviews with me on Fox Business and Bloomberg, just talking about the music industry. I talk every quarter when earnings come out for Spotify or Live Nation. I've done a lot of podcasts. So if folks are bored and they want to spend 5 minutes of their time listening to a music industry podcast, they can tune in. I've done quite a few. I've done a lot of ETF podcasts as well. So we're doing podcasts. We're running ads on CNBC. I'm doing a lot of interviews and just really evangelizing music. Andrew, as we're talking today, what I realized is for a long time, music was really a very misunderstood asset class for investors. And today it's simply too big to ignore. It's become institutionalized. It's something very unique. It's delivering very strong double-digit returns without the volatility of the equity markets. And so I think what's really interesting today, with Conor and Larry, we all represent alternative ways to get exposure to the music industry, whether it's through debt, through equity, through a public vehicle. And I think that you're seeing all these different vehicles. I think it's just the beginning. The SEC, as it relates to our vehicle, recently announced that ETFs can carry 15% of their ETFs with private deals. So it's not inconceivable that our ETF will be buying some publishing catalogs in the near future and selling off retail shares to the public. We've also looked at possibly tokenizing our ETF and for retail investors. And so I think there are a lot of opportunities with music today as an asset class. And, we're really representing something that's very liquid for investors to get exposure to. You have $10 trillion in ETFs today going to 20 trillion. I mean, these numbers are just staggering to me as I talk about them. And because everything's moving out of mutual funds, because mutual funds are so tax inefficient, right? You're getting taxed if you hold a mutual fund. You're not getting taxed if you hold the ETF, only when you sell it. And so we're just looking to get a small piece of that. And we think, music is something that all investors should consider adding to their portfolios.
Yeah, thank you. Tom, you got one, or do you want me to go?
We got a couple live ones on the hook here.
Okay.
So from Daniel Zarling, comment on the Stairway to Heaven controversy or any other copyright fights.
Does anyone want to take that?
Do we need clarification on that one?
Yes.
All right, Daniel, why don't you, if you don't mind, if you're still there, could you drop in a little bit more detail as to what in particular you're looking for the group to comment on? While we're waiting for Daniel to give us some more color on that question, Joey Z asked, well, first commented, hi, super interesting insights. Thanks, Joey. How do you think recent and upcoming U.S. tariffs will affect this asset class?
Oh my gosh, I had to write a whole thing about this. I'll take it just from our standpoint. It's like we have the loan portfolio in a bad place because of tariffs. It's interesting. We have mostly U.S. music, which is in the catalogs that are our collateral on our credit facilities, which is mostly getting exported all over the world. We haven't seen major tariffs hitting this intangible asset. And so it really has not affected us thus far. It has not really affected the cash flows. The that this music is generating from its consumption. Now, I don't know if anybody else wants to take it, but it's essentially been a non thing for us as far as increasing the risk of impairment to the cash flows. Anybody else want
Totally
to share?
One other anecdote I'd share is, we were out doing an ABS offering at the time of Tariff Day, whatever it was called, and
Liberation Day.
Liberation Day. Yep. So no impact on the cash flows, right? But different investors may see like a relative value impact, right? If you're looking at music ABS versus, car rental ABS, and you can get an extra 50 bips for what you perceive as a low risk to your ABS, that's the impact you see, but direct impact, we're not seeing any.
Yeah. Anyone else on that one?
Andrew, why don't you do one of the questions you had prepared for the Q&A, and we'll keep it on the chat.
Yeah, so here I've got one here that's about other revenue sources in the music industry outside of music copyright and these assets. I think we could take this to a lot of places. We've already heard from David that he's investing in something like Live Nation, and Live Nation is not really dependent on the consumption of music in your home for Live Nation to realize cash flows. They're dependent on the sale of tickets. I would say, so there are a few things as a banker. We're a full music industry group, and music copyright is one part of what we do, but we also lend plenty of dollars into the live music industry. I mean, whatever specialty use facilities like venues, festivals, live music infrastructure, where, the largest stage ever manufactured, portable stage, 18 tractor trailers to drag it around the country. That's our collateral. It took $2.5 million to build this stage, and it's called the Atlas, and it's one of the greatest stages in the world. So, I mean, like, you can find other ways to, that money is being generated in the music industry. We focused so much today on music copyright and how royalties are generated by the consumption or exploitation of that music copyright. But there's a lot of other money being made in other sectors of the music industry. Anyone else want to add to the way other revenue streams that are within the broader music industry?
Listen, the in vogue business today are immersive experiences, and and that is certainly an area that's going to grow over the next 10 years with technology advancement. We have our Bob Marley Hope Road show that opened last month at Mandalay Bay. We're doing Prince with another major casino. We're in talks with a lot of, call it, exhibitors for avatar experiences, exhibitions, etc., all across the world. I think that is a major growth area in the business.
Well said. Anybody else?
I think the cool thing about this, asset class is that there's infinite potential permutations of monetization, right? Like, I think we've invested a lot within the live ecosystem. Experiential generally, we're very bullish on as well. I think that, you can go off the other end of, Web3 tokenization. There's music will continue to be monetized in more ways than I think we're even expecting today.
Well said.
Hey, we're Andrew, if you'll allow me, let's come back to Daniel in a second. But
okay, the Stairway to Heaven conundrum.
That's exactly right. Yep. But Haley Powers had a question that relates directly to what you just asked the group about some of the socials. I'll read it verbatim. I think we touched on it a little bit earlier, but maybe we can expand on it. How does music listening through social media sites, Instagram, TikTok, contribute to asset revenues? Is money being generated from those sounds when they're attached to posts?
Yeah,
Larry, I think that's you.
I could, from our perspective, first of all, it makes up a very, very small portion of our overall revenue, but that's directly. So when you see the effect on marketing, promotion, and driving revenue, really what's happening is TikTok is ending up driving streams. So when you talk about TikTok, you talk about social media, you have to see what's the effect one, on the streaming, and two, what's the effect on the brand of the artist? Because the brand of the artist, especially if you're like a Primary Wave, where we buy name, image, and likeness rights in association with the music copyrights, things like social media have a very, very significant impact on our overall revenue formation and growth. But directly, it's a very small piece of income.
I think that answered it well. I mean, I would say there's some places where we've been seeing more folks that are, in the business of YouTube revenue, which isn't quite what you didn't mention YouTube in the question, but there's been some significant revenue generated via YouTube, and there are people aggregating that revenue, essentially purchasing rights to those YouTube revenue streams.
Yeah, people don't talk about it a lot, but if you just look at a place like India, 1/3 of our revenue stream in India comes from YouTube, and it's a dramatically growing area in emerging markets.
Wow.
Thank you, guys. All right, Daniel, the moment you've been waiting for. So let's go back to the Led Zeppelin question. Daniel offered some additional facts here. The fact that a portion of the famous song was similar to a former song that was unknown, but I think was upheld, it demonstrates that copyrights need more definitions and structure at a practical level. I guess this was probably back in the 70s, right? But please, if you will comment on that instance, if you have any knowledge of it, and maybe extrapolate out to today.
Yeah. So
talk about infringement. Larry, you were about to say. I'm sorry.
I was just going to say, if you look at all the songs that are created annually, all the songs that are put up on Spotify, and all the hit songs that have been created in the world, there are very, very few issues like this that pop up. They pop up. The Miles Davis thing popped up. This pops up. There are things that pop up every once in a while. But for the most part, people in the music business, producers, writers, record labels, publishers, all work collectively together to make sure that splits and shares of songs and interpolations and riffs that are used are appropriately apportioned. Every once in a while, an artist will say, "Hey, this person ripped off my song." And the producer or other artists will say, "No, I didn't." And that's when you get into a little spat. But, it's very, very few and far between that you get into these issues. But they do pop up. Interestingly, we are out every single day pitching our songs for interpolations or covers or using samples. So and a good example is Kendrick Lamar's "Not Like Us." If you think about the impact on samples, if you think about the impact of using riffs or interpolations, our Ray Charles catalog, and it's very interesting. Day in, day out, our Ray Charles catalog, grows steadily, right? But, it was doing 325,000 a year, 350, 375, growing steadily with our marketing effort. Hey, Kendrick Lamar comes along, and, all of a sudden, 2025, we're going to generate $2.2 million off of that catalog, and it's not going down, right? So these are very important areas, especially in rap, where where you're going to run into these problems. But again, they are so few and far between, because in the case of Kendrick Lamar's camp, they came and they talked to us in advance. Our creative people talked to them in advance. Not just Kendrick Lamar. It's dozens and dozens of artists each year are working with our creative team to use samples and portions of our song. We rarely have a spat.
Yeah, a lot of times it works out too. I think everybody knew because that Sam Smith song "Stay With Me" had Tom Petty and Jeff Lynne wrote "Won't Back Down," And Sam was like, I didn't even really know, I didn't even mean to do this, but I mean, like, it ended up actually being settled, and shown that, hey, that Stay With Me had such a similarity to Won't Back Down, that it ended up being settled very amicably, honestly. So I mean, a lot of times there are amicable settlements.
We have, we're one of the, I don't know, as I said, 5 or 6 largest music companies, right? 5 or 6 largest in the world. Okay. We've been in business 20 years. We've gone to court once in 20 years. And that was, by the way, to protect the copyright, because an artist did refuse to acknowledge that they ripped off one of our artist songs, right? And we did end up going to court once in 20 years, and we ended up winning the case, getting all our fees paid, and winning 100% of the copyright, because the artist refused to acknowledge, even though the artist went and got his own musicology report, and that musicologist said that it was copyright infringement, which, by the way, again, it's so preposterous, once in 20 years. It's just so infrequent.
Good answer.
Yeah, I'd like to add one other thing to Daniel's question. The Spirit song that you're referring to, or the Tourist song, was actually copyrighted in 1967, before the Copyright Reform Act of 1976. So the court actually used a lower standard for copyright infringement as it related to sheet music. In 1976, sound recordings altered standing for plaintiffs because they became protected. And so if you look at like the Blurred Lines case, which was, Robin Thicke and Pharrell were sued by Marvin Gaye, and then Marvin Gaye, you know, they actually had to show a much higher standard to win. They showed like 16 different times there was infringement. So very different today. If you want to sue, access and substantial similarity, the thresholds for suing are a lot higher today than they were in the Zeppelin case. And they lost too in the Zeppelin case. But it's very different today. It's a lot harder to bring an action for copyright infringement today.
Thank you, David.
Fun place to leave it. I have to kind of party pooper here. Sorry, guys. We're at time. We want to try to keep this rolling so folks can get back to their day or get home to their families. We do have a survey in the chat, and so if you have 30 seconds to take, we'd love to get every single person on here a response through our survey. If you want to give us all tens, that's cool. But some response would be awesome. And then Andrew, I'll hand it to you to close things down and see if the speakers have any final expressions they want to convey. Thank you on behalf of CFAW. Please keep an eye on our website for upcoming events, and I'll hand it to Andrew and the panelists to close you out here.
Yeah, fantastic. I'll close out. Let's start with Conor. Final words.
Yeah, no, I mean, really appreciate everyone joining. I think, as you probably heard, we're all passionate about the ecosystem. I think from an investment perspective, only thing I'd leave you with is, not just in music royalty asset management. I think that this ecosystem is undergoing a ton of change, right, and has been, and that just breeds investment opportunities. So it's a subsector that, we're very, very bullish on.
Right. David.
Oh, thanks for having me today as a guest speaker. Our fund represents a very diverse way. We talked a lot about copyright today, but as Andrew mentioned, we give exposure to live music events, to ticketing, to technology, to equipment. And so if you're interested in total diversification across the music industry, feel free to, look more closely at our fund. And if any of the investors or members of today's or guests are interested, you guys can follow me on LinkedIn, on Twitter, Instagram. I write a lot about the industry, post videos, and feel free to reach out to me anytime. My email is david@musq.com. Happy to chat further with any of you. But thanks very much, guys, and big thanks to Paula and Tom and Andrew and Larry and Conor. Great being on the panel with you today. Thank you.
Thank you so much, David. Larry, the great publisher.
Yeah. Well, Andrew, thank you for being such a great moderator, and thank everybody for participating. Always good to see David and Connor. And I've got to get to another Zoom 3 minutes ago. So
Okay. Go do your thing.
But thank you, everyone.
Fantastic. Thank you. I have nothing else to say. First Horizon and myself were very grateful to be invited to moderate here. So thanks everybody, and hope you all have a good evening.
Thanks, Andrew. Thanks, everybody.
Take care,
Thank
everyone.
y'all.